Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now today's discussion is crucial for every investor because every investor thinks about it in their investment journey. Switching funds, when to do it, how to do it, and why to do it. That's exactly what we'll discuss today with Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
So first up, when should an investor consider switching a fund?
There are only two reasons. Of course, there are many reasons which actually comes in the minds of an investor. Many a times you just think that it has gone up, so you have to sell. This is still the most frequently asked question which we get at Value Research Online. Booking profit. And if you don't book profit, then the profit will disappear. And, quite understandably, people think that it has gone up and it is an accidental thing. More so for new investors. It has gone down. You invested with a lot of hope. Time to, move to something because you picked the wrong thing. Not necessarily. There are only two valid reasons for which one should switch or sell one's investment. One is that your goals change. You invested for 20 years, that you are likely to have your job and you'll keep earning and it will keep rising. And you are likely to need that money after 20 years, and before that you are unlikely to need it, or 15 years or 10 years or whatever. And then suddenly you lost your job or something changed and you are likely to need a good part of that money 2 years from now. You need to change your track and you need to change your track immediately. This requires switching. Then, you decided to invest for the long run. You chose equity. You chose some good equity fund. And those equity funds stopped doing well. That is the second reason why you should sell. And defining that, how can you say conclusively that it has stopped doing well? You chose a 5-star fund, it became a 3-star fund, and it 4-star, 3-star. Rating does not change very dramatically. But over a period of time, it changes. And you picked a fund because it was 5-star. And this is also a very frequently asked question. That somebody picked a 5-star fund and now it has become a 3-star fund or 4-star fund. Is it time to sell? Not necessarily. It is a flag for you to start taking a closer look at it. But if it slips to 2-star, maybe consider selling. But more importantly, if your fund goes down in value, that itself is not a reason to sell. If your fund stops doing poorly as compared to all other similar funds, you should consider. If your fund is unable to beat its benchmark, you should consider. But over what time period? Over 3-year time period. Because there are good funds. They have done exceedingly well over the past 10 years, 15 years. And they have had a lean patch of, 2 years, 3 years. And they make a comeback. And the greatest of funds are unlikely to be doing very well all the time. Good fund managers also sometimes do poorly. Markets are cyclical. And then you should actually be flagged by the rating decline or rating changes or fall. In terms of being watchful, that has the fund manager left? Has the fund stopped doing something which it used to do well? Has it changed its focus? Watch out for the fund manager's interview on Value Research Online because we will be keeping track of things. So that is what guides our editorial selection. And that should be helpful.
Right. So you're saying that a change in, if somebody is following a star fund manager and suddenly he goes, that should not be a trigger to immediately sell off?
Not at all. In fact, it might be good news as well sometimes. We have seen that many of star fund manager has been replaced by a fund manager who turned out to be even bigger star. So, change of a fund manager is not necessarily a guaranteed doom for the fund. The fund may stop doing well. Just be watchful. Just keep an eye because, fund manager is very important. But the the fund manager change is also a very normal thing in this dynamic economic world where, new fund companies are coming, fund managers are getting older, many of them will retire, many of them will, lose interest, many of them will actually, lose their touch sometimes. So a change, one should be watchful, but change should not necessarily be a driver, a prompt to worry.
Okay. So once you've decided that we need to make a switch, what should be the roadmap of doing it?
In first case where your goal has changed, just plan it meticulously. That now you have to move from an equity portfolio of 100% to 70% fixed income portfolio. And that too over the next 6 months. Because 6 months or 1 year, if you need the money in 2 years' time, then you should do it in the next six months. If you need the money in 3 years' time, now the earlier time period was 15 years or 10 years, and now it has gotten reduced to 3 years, then you should do it over, there is no precise formula. But do it over a short period of time so that you are able to insulate yourself from the market risk for a very important goal for which you have already accumulated and you have succeeded in having that money. That should be a fairly arithmetic thing. You have 20 lakh rupees accumulated and you are likely to need it in 3 years' time instead of that 15 years. Divide it by 12 and move it to the fixed income. Don't do it at one go. But don't wait for the last day because you have accumulated all this steadily. Get out of it steadily in a shorter time period. When it comes to a poor performance, likewise, if a fund has stopped doing well, but the fund can also start making a comeback. Spread it over, 3 months to 1 year, but do it. If you have if you have arrived at a conclusion that this fund is no longer a fund which you would like to remain invested or continue investing, it's important that you decide on the destination fund, move it steadily. And if you have, if it turns out to be too horrible a fund and you just don't want to, maybe move that money from here to the other fund immediately at one go, switch it immediately. Reason is that the whole idea of staggering your investment, doing your SIP is to eliminate the possibility of catching a market high. But once you have already accumulated and you are disappointed with the performance, then you can choose the destination fund, your replacement fund, move this money, take this money out and invest it at one go. You don't have to stagger it over a period simply because it's important that you don't stagger it, because there is a possibility that you will be out of the market completely or substantially if you don't switch your money at one go.
So are there any tools that can help doing all of these things?
The biggest tool is Value Research Online and the Value Research ratings. These are the first simple, easy to understand flags for you that the fund has stopped doing well relative to its other options in its category. Second is that, monitor your portfolio on Value Research Online. You will get a sense of, how it has done vis-a-vis the benchmark in the performance tab.
Okay. Now, what are the common mistakes that investors tend to make while making all of these moves?
The biggest mistake is actually a variant of, fear of missing out. Your friend is doing well. He bought some fund which you don't have, and you think you have to necessarily invest there, not having a long time frame. And some of the myths which gets, somehow more, reinforced by the market behavior or, market or, salespeople or the relationship managers, that here is a new idea, you need to act on this, you need to do this, there'll be an internet fund, there'll be this fund, that fund. And it looks, it is a consumer product. People buy into those stories. And if it does well, then you think that I could have done it with my other investments. So one should really understand that there is a cost of too much of activity and you cannot necessarily act on each and every noise. You have to make sure that your good part of your money is diversified. It is invested in high quality portfolio. There will be times when it will do well, and a narrow category, some kind of fund, which is very narrowly focused, will keep doing well all the time. And you have to make sure that you are fully reasonably invested, diverse, spread your investments over multiple hands so that you are able to ride most of the ideas, and over a period of time you'll be well. Just because something has done very well, you don't have to be necessarily there.
So is there a periodicity at which one should be looking at the portfolio and making these switches necessarily?
In this noisy world, it's very difficult to resist the temptation to not look at your portfolio closely. But you don't, out of curiosity, we look at it every day. But take a closer look. If you are using Value Research Online, we have made it so easy that, import your portfolio, look at the analytics and see that where your money is spread, how many funds, what is the rating, and whether they are beating benchmark or not. Look at it every 3 months and closely review it on an annual basis to list the actionables. These are the funds which you are going to get rid of for this reason. These are the funds where you will direct your money. This is how you are going to change your allocation. Right now you are 100% into equity, and now it has become sizable, and you will make it 90% equity and 10% debt. Which debt fund? And from which funds this has to go. Executing all these things, all these transactions at Value Research has become so easy.
All right. Well, thank you, Dhirendra, for your insights.
Thank you.
Now, moving on to the viewer's question from here. Prasad Pai has sent in the question, and he says that he's been a long-time follower of Value Research and a subscriber to the Value Research Stock Advisor service as well. He initially began his investment journey with mutual funds and over time has gradually started investing in stocks based on Value Research recommendations. Currently, he holds a diverse set of mutual fund investments. Some are regular investments while others have not performed as expected. He's now looking to consolidate his portfolio into 4 or 5 well-performing funds. However, he's mindful of the potential tax implications of redeeming existing investments and would appreciate your advice on the best approach to do this efficiently. So he also invested directly through individual fund houses portals previously, and later when he started investing in stocks, he opened up a demat account with a fintech. So he's now considering whether it would be more effective to manage his mutual fund investments through the demat account or continue using the fund house portals. So if you could share your recommendation there.
He basically has 2 questions. One is that, he has too many funds in his portfolio and how to consolidate it in 4 or 5 funds. Is it a good idea? It's a good idea. Good idea for 2-3 reasons. One is that you will be interested in them and they better be good funds. But at the same time, don't overdo it. You should not take your money out from a reasonably okay fund and move it in, consolidate it in 3-4 of them and pay taxes on that. You don't need to. Get rid of those funds which are not good, and they are not good for a reason and you have decided that they are not good. If you have some niche fund, some thematic fund, some tactical fund, if it is not 5%, don't have them. Get rid of them. Don't have too many tiny positions. Consolidate, but not mindlessly. And the second thing that, Indian investors are very lucky. Whether you invest through a fintech, whether you invest in a demat account, whether you invest through a fintech without a demat account, or whether you invest in a mutual fund at the fund company's website, it doesn't matter. All your money can be consolidated and you can transact from wherever. All you need to know is your folio number, the name of the fund, and you can consolidate all of it. If you have invested all your life, come to Value Research Online and set up your portfolio, put your PAN number, put your phone number, and we will consolidate it in 2 minutes flat. And it will be ready to track for all times to come. Not only that, if you become a member of Value Research Fund Advisor, you will also be able to execute all these changes seamlessly. Switch your money from one fund to another. Whether you have invested through any one, it doesn't matter.
Well, that wraps up our discussion for today. We'll keep guiding you on how to improve your portfolio. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Thanks for watching. Bye for now.